What do we trade on the Forex market? The most obvious answer is money. Specifically, cash. Since you're not buying something material, Forex trading can be confusing. Let's use a simple example to demonstrate. Think of buying currency as investing in a company's stock, much like buying stock in a company. The currency's pricing usually reflects the market's opinion of each nation's economic situation, both now and in the future. Let's say, you are buying a share in the Nigerian economy. When you buy, you're assuming that Nigeria's economy is doing well and will keep getting better over time. When you sell those shares back to the market, you are hoping to profit. In general, the exchange rate of a country's currency against other currencies indicates how that country's economy is doing in comparison to other economies. You can trade a wide variety of currencies, but as a beginner, you should usually start with the major currencies. What is major currencies? As the most actively traded currencies and representatives of some of the world's largest economies, they are known as major currencies. There are 8 major currencies. These are the 8 primary currencies and their nicknames for Forex traders. The United States is represented as US dollar, with the nickname buck, euro for Eurozone with its nickname fiber, JPY for Japan yen, with yen as its nickname, GBP the Great Britain pound as cable, CHF Switzerland franc as Swissy, CAD Canada dollar as loonie, AUD Australia dollar as Aussie, NZD New Zealand dollar as Kiwi. Therefore, whenever you encounter the term Aussie in a Forex news story, it refers to the Australian dollar. It is important to note that all currency symbols are made up of 3 letters. The first 2 letters stand for the name of the country, and the third letter, usually the first letter of the currency's name, stands for the name of that country's currency. Tip: these 3 letters stand for the ISO 4217 currency codes. The International Organization for Standardization (ISO) created the 3-letter designations for today's currencies in 1973. For example, dollar in United States are represented by the letters D and US, respectively, giving you the money in US dollars. Simple, isn't it? As the most traded currencies, the ones displayed on the chart are called the majors. Forex trading, the buying and selling of currency pairs. What is Forex trading? Because you already know what Forex is and the participants involved. Forex trading involves purchasing one currency and selling another at the same time, through a Forex broker, or CFD providers. Currencies are exchanged in pairs. Currency quotes are given in reference to the base currency, which is another currency. For instance, the British pound is the base currency and the Japanese yen is the quote currency in GBP, JPY pair, or the euro and the US dollar, EUR, USD. You purchase or sell in currency pairs when you trade on the foreign exchange market. Depending on which currency is stronger at the time, exchange rates alter. Currency pairs fall into 3 categories: the majors, the cross-currency, the exotics. The US dollar is always one of the major currency pairs. The US dollar is not included in cross-currency pairs. Minors are another term for crosses that use any of the main currencies. One major currency and one currency from an emerging market make up exotic currency pairs. The following currency pairs are referred to as the majors. These are the most traded pairs and all have the US dollar, USD, on one side. Only 7 main currency pairs exist, despite the fact that there are 8 major currencies. The majors offer greater trading chances because the price moves more frequently than the crosses and exotics. The majors enjoy the highest liquidity. The degree of activity in the financial market is referred to as liquidity. In Forex, it is determined by the volume of trades as well as the number of active traders purchasing and disposing of a certain currency pair. The more often something is traded, the more liquid it is. For instance, compared to the AUD-USD currency combination, more people trade the GBP-USD currency pair and in larger volumes. This indicates that compared to AUD-USD, GBP-USD is more liquid. Major or minor currency pairs that cross currencies. Cross-currency pairs are simply the crosses, or currency pairs that comprise any 2 of the main currencies other than the US dollar. Minors are another name for major crosses. The crosses are still rather liquid and offer a lot of trading opportunities, despite not being traded as frequently as the majors. The 7 main currency pairs, which all feature the US dollar against one of the 7 other most liquid currencies in the world, should not be confused with smaller currency pairs. The 3 main non-USD currencies, EUR, JPY, and GBP, are the source of the most commonly traded crosses. A currency from a developing or emerging market is considered exotic. One major currency and the currency of an emerging country, such as Brazil, Mexico, Indonesia, Poland, Chile, Turkey, or Hungary, make up exotic currency pairs. In essence, an exotic currency pair consists of an exotic currency and one major currency. A few instances of exotic currency combinations are shown in the chart below. Remember that because these pairs aren't traded as frequently as the majors, or crosses, trading them typically entails higher transaction costs. Currency pair. Between Chile and the United States, spreads are 2 or 3 times larger than those of EUR, USD or USD, JPY are frequently observed. Exotic currency pairs are typically significantly more susceptible to changes in the economy and in geopolitics because of their generally lower level of liquidity. For instance, the exchange rate of an exotic pair may fluctuate sharply in response to a political scandal or unexpected election results. Therefore, keep this in mind while choosing whether or not to trade exotic currency pairs. An extensive list of exotic pairs can be found here. Extra tip. According to the UN, there are 180 legitimate currencies in the world. The volume and liquidity of the Forex market. The bulk of currency trading takes place on the interbank market. Unlike other financial markets like the New York Stock Exchange (NYSE) or London Stock Exchange (LSE), the Forex market does not have a physical location or central exchange. The entire Forex market is considered an over-the-counter (OTC) market since it is run constantly, electronically, and 24/7 by a network of banks and non-bank financial institutions (NBFIs). This suggests that the FX market, which is distributed globally, lacks a central place. You can trade anywhere you have an internet connection. The currency over-the-counter (OTC) market is by far the biggest and most well-known financial market in the world, with a market value of over $6 trillion. There is a lot of buying and selling activity going on at any given time due to the magnitude of the currency market. As a result, market liquidity, the ability to buy or sell a large number of goods with minimal impact on price, is very high. Market liquidity is important for traders with short time horizons because it determines the rate at which a price might change over a certain period of time. In a market with high liquidity, like Forex, large trading volumes can happen with no effect on the price or price motion. Even though the FX market is quite liquid, the market depth might change depending on the currency pair and time of day. Please like and subscribe for more contents.